And welcome back, ladies and gentlemen. The boot camp continues, and so does our understanding of market structure. So you may remember the last market structure lesson that we covered. We covered higher highs, higher lows. We covered trends, consolidation, power of three, a whole bunch of concepts. But this lesson, we're going to take it a level deeper. We're going to get slightly more granular and start to point out some of the more nuanced market structure concepts. So now that you understand the basics, let's go ahead and get into it. But first, let's refresh on the concept of swing highs and swing lows. So you may remember swing low, bullish swing point, when we have a low with a higher low to the left and the right. Now, that would be your swing low. And the opposite, swing high as a high with a lower high to the left and the right. So that is swing highs and swing lows. If you remember, we labeled a few of these. You also have by now gathered several examples of this. So you should have a pretty good understanding of swing highs and swing lows. Now, how do we differentiate though? Because as we know, the market makes a lot of highs, a lot of lows. How do we tell which of the lows and highs are important versus which ones are less significant? Well, that's where we move on to the different types of swing highs and swing lows. First of which is intermediate term swing lows. And what is an intermediate term swing low? It's a low with a higher swing low to the left and a higher swing low to the right of it. So unlike a swing low or a swing high, this is a combination of swing highs and swing lows, with the lowest one being between a higher swing low and a higher swing low. And don't worry if this is confusing, we will point out several examples on the charts, but just know it's the lowest swing low between other swing lows. So that is an intermediate term swing low. And what about intermediate term swing highs? Well, an intermediate term swing high is a swing high with a lower swing high to the left and the lower swing high to the right. And that is your intermediate term swing high. Now we're going to go on the charts. We're going to mark some of these out real quickly. So let's go ahead and do that now. And we're on the charts now, guys. And what do we see here? Well, price came down. It made a swing low right here. So here we have a swing low. That's a low with a higher low to the left and the right. What is this to the left of that? That is a low that we made down there. What is that? Higher low. What is that? Higher low. So we have a swing low. Boom. We have a higher swing low to the right. Now, do we have a higher swing low to the left? Well, yes, we do. We have one right here. So we have a swing low right here. Lower. We have a higher low here, higher low there. So that is an intermediate term swing low right here. So you can see that's the lowest low we made. Now let's see if we can find an intermediate term high. You can see right here, we also have an intermediate swing term high. So we have a high up here, right? Lower high to the right, lower high to the left. What do we also have? Well, we have this high here that's lower as well, but this wasn't necessarily a swing high. So right here, what do we have? We have a high, lower high, lower high. And then over here, what do we have? We have a high, boom, lower high, lower high. So this one right here would be our intermediate term swing high. And you can see that's the highest high that we made before starting to drop down. Now, there are a couple other types of intermediate swing term highs and swing term lows, and we'll get into why these are significant in just a second, but for now we're just focusing on learning how to identify them. We'll explain further what they mean and how to utilize them later in this session. So the next type of swing high and swing low is a rebalanced intermediate term low, and it's simply an intermediate term low that rebalances a fair value gap. So instead of just a regular swing low, it's one that rebalances a fair value gap. Same thing on intermediate term rebalanced high. It is simply just one that forms within a fair value gap that gets respected. For example, right here, I know we haven't covered fair value gaps yet. That's coming in 1 or 2 lessons, guys, coming very soon. But you can see here we have a bearish fair value gap. And what is that within that bearish fair value gap, guys? Well, I believe that is a swing high. We made a high up here, respected that gap, lower high, lower high. That is also an intermediate term rebalanced high. And then you could see we have one right here as well. Fair value gap. That's a high up there. That's a high up there. And then to the left, lower high. To the right, lower high. Now let's see this on the bullish side. You can see right here, bullish fair value gap. And then you could see low down here, higher low, higher low. So those are two examples of a rebalanced swing high, and then one example of a rebalanced swing low. And here's one more example of that as well. You can see we traded into this fair value gap right here, and then we made a rebalanced swing low over here as well. Low, higher low, higher low. So you're starting to see how this works and the significance of certain lows. We're going to dive much deeper into it, but let's first dive into the next concept, which is long-term swing lows. So what is a long-term swing low? We went through swing lows and swing highs, the regular ones, intermediate ones, rebalanced intermediate ones, now long-term highs and lows. Well, a long-term low is simply a low that is formed off the reaction of a higher time frame level. So a daily, a weekly, a 4-hour, this could be a fair value gap, this could be a liquidity level, high, low, whatever the case may be, but it's just a lower high that forms there. And bonus points if you have an intermediate term low as well that forms. That's typically what happens whenever you have a long-term high or low. Is you'll see the sweep, and then it'll leave a intermediate term high or low relative to the direction that you're going in. So let's go ahead and see if we can find an example of that as well. So we'll go up to our higher time frame to go ahead and establish this. See what the last time was when we entered a higher time frame level. Probably be this daily order block right here. And I guess I'll just draw this out with the box for now. So that is a daily order block. And you could see we tapped that quite a few times. Now what I'm going to do here is I'm going to see if we make an intermediate term high or intermediate term low when we touch that gap. And then I'm also going to see if we make one when we cross that daily area right there. So let's keep an eye on those two levels here, and let's see what happens. You could see, boom, this right here goes into that gap. What does it do, guys? Makes a low right here, higher low, higher low. And you see after that, starts running up. So that is our long-term low there, and it's looking like we may continue to price higher. Market's still actively open, but that is looking like it may want to put in a long-term low. Now up here, you can see we put in a long-term high when we came up into that daily level / weekly high. And then you can see, boom, high up here, lower high, lower high. What is that? That is a long-term high. And then you could see as well, we made another high up here, high, lower high, lower high. And then what do we have to the left of that? We have high, lower high, lower high. And then to the right of that, high, lower high, lower high. So what is that also? Intermediate term high. That is the signature right there, guys. Swept a higher time frame level, put in a long-term high, boom, created an intermediate term high. So now we really know it's about to go down. And if you're really watching closely, you would have seen as well that's a 15-minute bearish fair value gap. So you're starting to see how these concepts fit together. We haven't even got to fair value gaps yet, and you're already starting to learn how to spot those reversal points or those market maker sell and buy models that everybody talks about. So that is long-term highs, long-term lows, intermediate term highs and lows. Let's get into some other concepts that are going to help you guys spot reversals and also start getting some entries. So let's move on. We covered a lot, but we're covering more. Change in the state of delivery. So some of you guys may have already heard this. Change in the state of delivery is simply a signal of a potential reversal. So whenever you see this, it is a potential signal that price is ready to start moving in the opposite direction. It's confirmed when price closes above the open price of a previous down candle and a bullish scenario. So you see here we closed above the open price of that candle. If you refer back to open, high, low, and close, you should know these terms. You should have studied this by now and have a good understanding, and it's because we're about to apply it in a lot of different ways. So changing the state of delivery right there, and then it's below the open price of a previous up candle in a bearish scenario. So you can see right there, changing the state of delivery. We close past the open price of that bullish candle, and a nuance after we swept liquidity. So you always want to see the liquidity sweep. Otherwise, you don't even know if it's a protected level. So both those we got to sweep. And you can see here we did price above it, but we did not close above it. Remember, bodies tell the story, wicks do the damage. Every single one of these concepts I'm teaching you ties together with all the other concepts. And same thing here. Did not close below that open price, so that is not an order block. But in both these cases, these are order blocks because they closed past that open price. That is a change in the state of delivery. Now, market structure shift. Here's another one, and we're going to go ahead and hop on the charts and go over these as well, but I want to introduce both of them to you guys. Market structure shift. It is similar to a change in the state of delivery. It's also a high potential for reversal, so it's one of the potential reversal signals. Price makes a swing high, so low, lower high, lower low. Remember the trend. So it trends bearish into a buy side liquidity, or so it trends bullish into a level of liquidity. That should say sell side liquidity, so don't fucking look at that shit. That should say buy side. But who the fuck made these slides, bro? Who the fuck made these slides? Price makes a swing high at a sell side liquidity level, or PDA, and then displaces and closes above the high. So you see, boom, low, lower high, boom, sweeps liquidity, and then we displacement, and we close above that swing high. Remember, swing high is high, higher low, higher low. You know, it makes that swing high going into the liquidity, sweeps the liquidity, displaces, closes above that swing high. It must close above. It can't wick above, has to close above, guys. And same thing when bearish. You want to see that swing low get put in, sweep liquidity, displace and close below that swing low. If it does not displace and close below it, that is not a market structure shift. So now that you understand that, we'll go ahead and take a look at some examples. So just make sure you're taking screenshots of these so you can refer to them for later. But the last concept is break of structure. Now, a break of structure signals a potential continuation of a current trend. So a lot of times, trading my continuation model, you are trading off of the assumption that we're going to have a break of structure, right? Price has already hinted at a trend from London, and you're simply trying to catch that retracement in the new break of structure, at least for the continuation model. So a break of structure signals a potential continuation of the current trend. Price retraces from a market structure shift, then continues higher, displacing and closing above the previous high. So that's our bullish scenario right here. We had the market structure shift already, left behind some fair value gaps and stuff, and we retraced, broke structure again to the upside. And we broke structure again to the upside, and we closed past that swing high. And then on the bearish side, you can see we had that market structure shift, retraced, boom, and then we had that break of structure right there, closed and displaced below that swing low. You can see here, we did not have the break of structure because the trend didn't displace and close. And same here, we did not displace and close above this high. Therefore, the trend is not signaling that it wants to continue. So let's go ahead and hop on these charts now. We're going to find an example of a change in the state of delivery, market structure shift, and a break of structure. And you're going to see how cool these concepts all work together. So right as we open our charts here, we're actually seeing a pretty good example of one. So let's go ahead and drop back down to that time frame. You see we priced into the daily order block. We also swept some lows. And what do we notice here, guys? We notice that we have, what is that? A change in the state of delivery. Because if we fast forward to here, you can see open price of that bearish candle. We swept liquidity and we're in a daily fair value gap. And what else did we do? We made a low, displaced and closed above that open price. So that is now an order block. You'll learn about that in a future lesson as well. And this is now a change in the state of delivery, guys. So let's see what happens here. You see, it prices off that order block. See how well it respects the 50% point of that order block. It's a beautiful respect to that right there. You can see mean threshold of that order block being respected. Now, don't worry if you're confused right now. You're going to learn all about this and what that is. Simply focus on the change of the state in delivery that just happened right there. So make sure you go through and you journal a couple of these. We're going to go ahead and find a few more here as well. But for your examples, just make sure you know how to label these, what they are, and where they form. So changing the state of delivery. And then what else do we have, guys? Well, we now have a market structure shift because it made this swing high, boom, came below, made a low, and now we broke that structure. We closed and broke above that high. So that is now a market structure shift. Some people might say that that shift down below was a market structure shift, but this is what I would consider a market structure shift because we did not leave a low here. We left a swing high, but we did not leave a swing low. And here we left a swing high, then we made the low, and then we shifted market structure, leaving behind a fair value gap. So that is a market structure shift. A lot of people would see that and then start to hunt this fair value gap for an entry, or that little order block below even potentially. And let's see what else price does. So you see, boom, we go ahead and we price into there. We get a reaction. Price is still not fully finished delivering from that level, but you can see it's holding some bullish structure. So that may end up being a break of structure if we're able to close past this high. So this is actively potentially a break of structure right there. If it doesn't, then it's simply not a break of structure, and we know it might come down and break the trend. Now let's look for a couple more examples. Let's go back up to this example that we had here. Remember, price comes up into this level. This was a higher time frame level. And what do? We displace and close below the last up close candle after sweeping liquidity. So what would that be? That would be a change in the state of delivery. Again, guys. So you're seeing this is always happening, and you're probably noticing how we combine these concepts now to really tell, like, okay, is this just reversing or continuing? Will the market top out here, or is it still running? Like all those questions that you've had, if you haven't had an answer to them, these are all the little pieces that tell you how to get a read on those things. So changing the state of the delivery, you see we end up pricing down, and then we also get a market structure shift. Because we made a swing low up into the high, boom, closed below that swing low, and we left a fair value gap right here as well on the bearish side. So that is a 2022 model. We'll learn about that later, but as you can see, market structure shift once again, but this time towards the bearish side. And let's see what else happens. In this case, we do get our break of structure because we make another low after closing below the swing low, and then we actually break past it once more. So that would be a break of structure. And then let's see what else price does. See, it goes down even lower, and that's another break of structure, guys. And you can see it respected this level very well too. And then if you measure that, guys, what else is it? Is that a golden zone right there? So we're starting to see how all this is getting closer to getting you guys in a trade, and a very great trade at that. So just be patient, guys. The process is unfolding. Make sure you're gathering examples of this as well. Changing the state of delivery, market structure shift, break of structure, and start labeling out those intermediate and long-term lows. But this should be plenty of technical concepts to get you to the next lesson and to also add an extra layer of understanding to the current concepts we've introduced. Appreciate you guys being here. Day 12, day 13 is tomorrow. And guys, we're almost halfway there. So if you're excited with how things are moving, if you're learning stuff, if you have any requests of what to teach next, guys, now would be the time to spam them below, because I'm going to make sure we fit everything we need to into the rest of this 30 days. But I truly appreciate you being here. Stay blessed, stay up, and I'll see you guys in the next one. Let's get it.